You can start.
Good afternoon, friends. For joining this call to discuss equity outlook, HDFC Focus 30 Fund and HDFC TaxSaver. We have with us today our senior fund manager, Roshi Jain. Before I hand over or invite Roshi to take over this call, a word about her background. Roshi recently joined us in the month of January. Before joining us, she worked with Templeton since 2005, where she was managing 3 products or 3 funds, Focus Strategy there, Templeton Blue Chip, and Templeton Build India Fund, roughly around $2 billion of the funds that she managed. She started her career with Templeton in 2005, and before that, she was working for Goldman Sachs at their London, Hong Kong, and Singapore offices. Roshi, by training, is a management graduate from IIM Ahmedabad. She's a chartered accountant, ranked all over India second in 1998, and she's also a certified financial analyst. So she comes to us with a wealth of experience and track record, and I'm sure that she will make good out of this. Roshi, before we invite you on this call are our pan-India distributors, investors, and our branches who are keen to listen to you, your thoughts on equity outlook, economy, and of course, the crux point right now is Ukraine crisis, oil prices going up, inflation, interest rate movements, so many things happening globally and locally. So with this, over to you, Roshi. And before that, my colleague Ram will be there as a moderator for this call. So with this, Roshi, over to you.
Just one announcement. Just one announcement before we start. For people who wish to ask a question, you can use the chat window, and we'll take all the questions towards the end of the session. Over to you, ma'am.
Thank you. Hello, everybody, and thank you for taking the time to attend this webinar. Interesting times indeed. This is my first interaction with all of you at HDFC Mutual Fund, and what a day that we have chosen. Not just, I mean this more from a markets perspective. I can already see the first question which says views on the global route. So I structured the webinar a little bit differently, but then I realized that Putin and Ukraine are probably top of mind for everybody. So let me start off by giving my 2 cents thought on the immediate sort of impact from all of this. I think the main channel of transmission of this crisis from an India perspective is the crude oil, the spike in crude oil. And the immediate reference point probably is we are all going back to 2007, 2008, maybe when crude was, again, we saw a sharp spike in crude. And I'd like to sort of place the current situation relative to that reference point with sort of a few things to keep in mind. The first is that the crude oil intensity of the economy today is much lower than it was, if we go back to our previous reference point. And I just have a few numbers that I will quickly talk about. In 2007, the daily oil consumption was about 2.4 million barrels. And today that number is about, or FY23, that number is estimated to be at about 4.5 million barrels per day. This is India consumption. So it's not even doubled in the last 15 years. But if you look at GDP, from $1.2 billion in 2007, we are at about we will be at about $3.5 billion in FY23. So therefore, the point that I want to make is that the crude oil intensity of the economy today is a lot lower than it was, when we saw the previous spike in crude. Point 2 is that there is no subsidy on transportation fuels in India this time, unlike the situation maybe 15 years ago, and therefore the fiscal drag from higher crude is not a disruptor this time around. Albeit because a portion of the taxes are ad valorem, actually some, especially the state taxes, states may actually be benefiting from the higher crude price. But the fact remains that because there is no subsidy on transportation fuels, the fiscal drag this time is not a risk. And of course, the final point is that crude at 130 itself, the question remains, can it sustainably remain at such high levels for a long period of time? So there can be both demand destruction as well as supply response. Crude at 130 brings in a lot of incremental supply. We have shale in the US, there is spare capacity in the Middle East. There are talks of Iran coming back into the oil markets. So there could be a supply response coupled with demand destruction at $130 or higher. And therefore, it's possible that we may not see crude sustainably at this level for a long period of time. So a combination of these factors, which is that lower intensity of crude to GDP in India during the current scenario, as well as the fact that there is no fiscal drag from crude in the form of subsidies, and a question about whether crude can sustainably remain so high, makes me feel that the situation with respect to crude may not be very dire. There is no doubt that there will be an impact on GDP growth as well as inflation for a period of time that crude remains high, but it appears to me more transitory than having a more medium to long-term impact. The second question, the corollary from that is the impact on the currency markets. So while we have seen risk-off related flows in the form of FII selling, again, I think there are two counterbalancing factors here. First is the domestic participation in equities has been extremely strong, and we've seen that trend over the last several years. That, to my mind, is an extremely strong counterbalance for the global risk-off that one is seeing. And secondly, we've also seen good growth in FDI flows in India, which are more sticky, and therefore, unlike, let's say, 2 decades ago, when we have seen that there was little counterbalance to FII flows. Today, we have that counterbalance from greater domestic participation in equities, and we also have a more sticky source of capital flows, which is FDI flows. So therefore, in summary, I think that the impact from higher crude as an outcome of the situation in Russia and Ukraine is probably more transitory. It's offering us an opportunity to buy stocks that we like at much more attractive valuations that they probably traded at a couple of weeks ago. And to my mind, I would be using this as an opportunity to increase exposure in equities that tick the boxes on fundamentals, and we now have the added trigger of much more attractive valuations. There are a couple of longer term issues also that I want to talk about. I don't claim to have the answers to them, but I thought I must put them in front of this audience. The first issue is that, are we going to see a new Capex cycle in energy markets? Now, we know the huge dependence that the European markets have on Russian gas. In fact, Russia is a large exporter of several commodities. So are we going to see a new Capex cycle take shape in the energy space? That's something that I want to sort of, I will leave this for thoughts about the outcome, a more lasting outcome from the war. And the other question is, does this accelerate the sort of green initiative, solar power, renewable power shift, or does it lead to more capital allocation on old energy, because old energy is still a substantial part of the energy consumption? and how the future unfolds in terms of balancing out the shift from old energy to new energy and the shift from Russian dependence, I think is some of the more medium-term impacts that one will need to focus on as time progresses. The other question, of course, also is that will defense spending also see a pickup? We've already seen some countries talk about lifting defense budgets, and how will how will budgets of countries sort of balance themselves between the different priorities, with the defense also now coming in as an added demand on the fiscal balance sheet of countries. So these are some of the more lasting implications, I think, from the war. And this is something that probably will give us newer investment ideas to ponder about, to sort of think through from the more medium term. Let me now shift attention to the other global issue, which was top of the mind before we had this Russian-Ukraine crisis, and that was the trajectory of interest rates. Clearly, the trajectory of inflation was much more than transitory, which was what central banks were talking about last year. But I think they've started to realize that this is not just transitory, but it's probably a lot more embedded in the economy. And the Ukraine crisis is not making things easier. It just fuels further inflation. The question is that, I mean, of course, there is quantitative easing has to end. The question is, does it become more neutral, or does it move to a more tightening territory? I think this is something that developed market central banks are grappling with. We always knew that there was some amount of kicking the can down the road by continuing to extend the quantitative easing. Also, the fiscal as well as monetary response to COVID from the developed markets was extremely high. And as they start to unwind some of that, and this is going to pose a challenge to developed market growth. And in that context, I think Asia seems extremely well positioned for a couple of reasons. One, because the fiscal and monetary response to COVID that came from the emerging markets, especially the Asia side of emerging markets, was nowhere close to what we saw in the developed markets. Therefore, the pressure to unwind is a lot lower. And secondly, real interest rates in Asia as well as the emerging market complex are looking a lot more attractive than they are in the developed markets. We don't have the same inflationary challenges. And to that extent, therefore, the outlook, I'd say, for India, Asia in general, but India more specifically, which also has organic growth drivers, seems to be extremely attractive. With this broadly covering the global issues which seem to be top of mind, let me just move over to India-specific factors. So when I say that, relative to what the developed markets have to go through in the form of tightening, monetary tightening, as well as the sensitivity of growth because of higher interest rates, because the productivity as well as growth drivers in the developed markets are a lot lower than what we have in India. Let me spend some time on the India outlook, which is probably known, but I think time to time we need to reinforce it, just so that we know that when we are selecting stocks, when we are positioning portfolios, we do consider what the macro outlook is and how to tie that in with stock as well as portfolio selection, stock selection as well as portfolio construction. So as far as India is concerned, I think the consumption part of the economy had been sustaining growth for several years now. The investment part, as we all know, had been struggling. But I think that's where we are likely to see a turn and incremental contribution to growth come from. Investment, let me break down the investment story into a few parts. The first is public government spending. Now that has been fairly robust. I think over the last several years, we've seen government Capex step in, whether it's central government or state government Capex. And that has actually helped to offset some of the weakness that we have seen in the private in private capex. However, we now believe that private capex is at a point where there are now drivers for growth. Private balance sheets are now deleveraged, especially in certain large sectors such as steel. The banking sector now is, has the capacity to lend, having gone through the NPA issues and sort of cleaned up a lot of the NPA issues that existed. Today, we have much healthier corporate balance sheets as well as bank balance sheets, and a combination of that at least ensures that balance sheet capacity is available for participating in capex growth. I think we are at a point in time where corporates are now having to start to think about capacity creation over the next 2 to 3 years as demand comes back. 3 years out, definitely new capacity will be needed, and there is always a lag between, there is a time lag for creation of capacity. So if you start today, it could take anywhere from 18 to 24 to 36 months for the new capacity to come, and therefore it does appear that having done the tough job of deleveraging and cleaning up balance sheets, corporates are now starting to think about the next stage of capacity creation. Government steps have been extremely helpful in that regard. Tax incentives on new capacities, income tax incentives on new capacities. The PLI scheme, which again is an extremely powerful tool that the government intends to use, both from an export augmentation perspective as well as an import substitution perspective, can provide a fairly large kicker to private capex. COVID has also sort of created a new stream of capex, I think, in the form of the China Plus One strategy, where large global companies are now looking to diversify supply sources. So I think a combination of this provides a favorable backdrop for private capex pickup. From a point where only public capex was participating in the entire investment theme, we will now start to see even private capex sort of come back. The other part of investment, of course, is real estate. As we have seen, we've had a fairly weak real estate cycle over the last several years. That, of course, has started to turn. Again, there, a combination of low interest rates, consolidation in prices over the last several years, coupled with better incomes, has led to better affordability. The RERA, of course, has led to greater seller discipline. So I think and of course, mortgage rates are extremely attractive. So I think we are also at a point where we could have a fairly robust real estate upcycle, which will also contribute to the investment part of the economy, which had been pretty muted over the last several years, but will going forward start to contribute to overall GDP growth. With that broad economic outlook, let me also move to portfolio positioning. The broad construct around portfolios remains pretty much tied into the outlook that I just talked about, which is that we are of the view that the domestic cycle led by investments is sort of bound for an uptick, and therefore the TaxSaver as well as the Focus 30 portfolios, which are the portfolios that I manage, are positioned for participating in this upcycle. So the overweights in the portfolios are the banking space. We think that we are poised for credit uptick, and the large banks, having cleaned up the balance sheets, having a strong capital situation, and have the ability to participate in this credit uptick. So we are overweight the banks. We are overweight domestic industrials because, like I said, we are positive on the uptick in the capex cycle. Selectively participating in the real estate uptick as well via property as well as more upstream companies. The other sectors that we are positive on are an outcome of the PLI as well as the China Plus One strategy. We think that there are certain government companies which can participate in either import substitution or better exports, especially on the defense side, and we think that they are good bets in the current context. Also, pharma, which is a sector that has not seen much returns over the last few years. We think that there again, probably the cycle around the US generic pricing is probably the worst is behind us, and we should see volume growth coming from the US markets. Of course, domestic markets continue to remain a steady, stable story, which should continue to therefore provide visibility around earnings growth on the pharma companies. Underweights remain consumer staples, discretionary, IT as well. And let me sort of tie in the reason for this overweight, underweight stance. So while I tied that up in with our economic outlook, let me also tie that up in with some of the common threads around these sectors. I think it's I think the key criteria is from a stock selection perspective is about looking for good quality companies, but also companies that are trading at reasonable valuations. So it's about the discipline of focusing on valuations alongside looking for growth and quality in companies when we are assessing them. And when I say growth, it's not necessarily near-term growth, but we are talking about more medium to long-term growth. This would involve a considered evaluation of the industry cycle, the business cycle, and positioning ourselves at times ahead of the market as well. Also, it's important for us to look for companies that tick the boxes on corporate governance, on ESG sensitivity, on transparency. And we look at all these factors in a contextual perspective and not necessarily a very sort of checklist type approach. Also, the aspect that probably I want to emphasize on is reasonable valuations. And from that perspective, if you look at the portfolio, most of the sectors that we are overweight on provide that visibility of medium-term growth at reasonable valuations. And I think that the correction that we have seen in the markets over the last couple of weeks on account of geopolitical issues probably gives us that opportunity to continue to look to add to exposure in those companies which tick the boxes across these different parameters that I talked about. So with that, let me sort of stop here, and we'll be happy to keep it more interactive and happy to take questions.
Thanks, Roshi. So, Ashok, you are there? You have some questions, or should I start with some of the questions that I have and the audience questions?
No. I can start here. Can you hear me, Ram?
Yes.
Yeah. Roshi, before we invite questions from the viewers, audience, my first question is this, that we have seen the kind of volatility in recent past in last couple of weeks, starting with the Ukraine crisis, and then before the Ukraine crisis also, there was some volatility coming from the developed markets. Now, similar kind of volatility we saw 2 years ago when COVID was there. In February, March, there was a heavy selling by FIs to, I think, the tune of 60,000 crores. And we saw this kind of volatility where market tanked by nearly 40%. Now, what is the difference that you see in that kind of volatility and this? Are these two scenarios different? That's the first question.
So, the way I think about it is what is the impact on the portfolio and what is the impact on the stocks that we hold? The global landscape is always going to have some geopolitical issue or the other, some macroeconomic factor in some part of the world. The question remains how robust are our portfolio stocks, and will they be able to deal with this kind of disruption, which is really a part and parcel of sort of operating in a global environment where there are such strong linkages now on the trade side, on the capital flows side. So I think just given these strong linkages, volatility is now something that we should all learn to live with. The only thing I'd say is we need to think of volatility as a friend and not get worried with it. And over long periods of time, genuinely, some of these periods have provided extremely good entry points. The question that we need to focus on really is how robust are our portfolio companies to deal with this volatility. It's one thing to say moats exist, etc. The question is to actually time test them and see whether companies are able to deal with the kind of global events, how foolproof they have made themselves, how quickly they are able to recover from any sort of global events that impact them, and how they make business models future proof. I think those are the things that we need to focus on now, whether the disruption comes from COVID, whether the disruption comes from a Ukrainian crisis, whether the disruption comes from something else. I think if a company has sufficiently foolproofed itself, that's what we need to worry about, and that's what is important to sort of focus on in our portfolios.
Okay. So another question more to do with the two strategies that you have been managing at HDFC, Focus 30 and the TaxSaver. And now recently you have taken over in the middle of January. Now, both have a different strategies. So what is going to be your approach? Or rather, let me put it this way. When you look for a stock, what are the things that you look for a stock? And when it comes to this particular strategies, Focus 30 and TaxSaver, how you intend to take them forward?
I think the broad construct of the portfolios is probably similar, which is that we are looking for names where we can take advantage of the economic outlook that we have. At the same time, marry that economic outlook with the bottom-up stock selection criteria, framework, investment philosophy that we sort of follow. And that's why broadly you will see that both the TaxSaver as well as the focused equity has a predominance of domestic oriented sectors to participate in the investment cycle. The difference, I think, will be more in terms of execution of that strategy, which is that TaxSaver will be a lot more diversified, just given the profile of the investors as well as the nature of that fund. 3-year sort of lock-in, therefore, the ability to be more strategic and longer term. Whereas focused will be a lot more sharper. Because we are limited by 30 stocks. So within the broad construct of looking for stocks that will benefit from our economic outlook and which we like from a bottom-up perspective, focused fund will be a lot more sharper in its execution. Therefore, the potential for volatility in the focused is a bit higher, not a lot. So if you come with a long-term perspective and focused as well, you will not feel the higher volatility. But I'd say that both are broadly similar in terms of the themes that we are wanting to play, just that the execution will be a little different because of the limitation of 30 stocks in focused, which we don't quite have in the TaxSaver. But the TaxSaver, because of the nature of the investors, will probably be more diversified and therefore lower volatile.
Okay. Roshi, one more question before I then hand it over to Ram is that if you see from March 20 bottom and of course the rally that we saw and the correction also that we are seeing right now, we are seeing that typically what we call growth or quality stocks are losing much more momentum than the value-based stocks. So what are your thoughts on that? Is there some change that you are witnessing?
So I think these terms that we give, growth and value, etc., that all probably changes with, it's all contextual really. banking, which several large banks were considered value stocks, but frankly, we've seen very, very good growth participation in these companies as they've been able to take market share. Similarly, either to what were called growth stocks, especially in the consumer staples names, are going to sort of find it a little bit difficult to grow given the kind of commodity challenges that they are facing. So, you're going to have to deal with an environment where you may have to take prices up by 15-20%, and therefore there will be demand implications and impact on growth as well. So I think there are no sort of prefixed growth and value stocks. This is all a function of the industry cycle, the business cycle, and as long as we take a more cycle adjusted view of growth, we will find that there are opportunities in the so-called value names, which I think that they have enough growth levers, but those are available at reasonable valuations. Many of those are linked to the investment cycle, and I just talked about why I think we will have a robust investment cycle. Many of those so-called value stocks are bracketed because of their association with that investment cycle. As we see that cycle turn, you will see growth come back there, and they no longer will be value stocks. Actually, they can be good growth stocks which are available at reasonable valuations, and I think that's really the bigger opportunity to be getting those. That inflection point is what brings the maximum returns, I think. And if we are able to identify stocks that move from that so-called value attribute and start exhibiting growth characteristics and are available at reasonable valuation, we will see re-rating, plus we will see a combination of returns coming from re-rating as well as earnings growth.
Good. So I'm seeing a lot of questions being posted on the chat box. I think Ram, you should take it over.
Thank you, Ashok. Thanks, Roshi, for very clearly articulating all your ideas, and it's been great to have you. So I'm going to ask the first question again. It's the style question only, because many people who have interacted with me over the past few days, they have been wanting to know more about the style of Focus 30. Will there be any change? And also the TaxSaver as well. So probably I'll try to put this question this slightly differently, because you also mentioned that you are underweight on consumer staples and consumer discretionary. So my first question will be that, is that also on value consideration? Because typically we have been knowing that these are the sectors that trade at typically slightly higher multiples, while value and growth are same thing of the two sides of the same coin. What is your style? Is it like I will not pay any price in the name of quality, or I want to balance out both? Because definitely there are two schools of thought in the market as well, because on one side there are really expensive stocks, on one side they are probably cheaper stocks, at least from a PE perspective or relative valuations perspective. So I'm just asking the same question, probably just wanted to get a little deeper into that.
Sure. No, I think the sweet spot is really to be able to get growth and to get it at reasonable price. And that's both the challenge as well as sort of the fun of investing, I'd say. And like I said earlier, this growth is all in a contextual perspective relative to the industry cycle and relative to the business cycle. The last several years have seen a poor investment cycle for reasons that we are all aware of. Nevertheless, there have been companies in that space which have used the opportunity to strengthen business models during that period, and strengthen balance sheets, strengthen operating models, so that when the new cycle sets in, they are able to take advantage of operating leverage that comes in. As well as higher market share, because a lot of weaker players probably in that sector may not be able to bear the weak cycle. And that's really, and so you will see them grow once we see that particular investment, the industry cycle turn, we will see growth come back in those stocks, sectors, etc. Similarly, I talked about consumer as well, where there could be challenges around growth. And again, there will be companies that, of course, manage the environment very well. there will be companies that have extremely robust business models, and they will use this period of high commodity prices in order to gain share, in order to strengthen their presence in the marketplace. The question is, do you get where is the combination of growth with reasonable valuation? Because like I said, if you can make returns from both re-rating as well as earnings growth, why not? And that's really what I'm looking for. It's not about a straight-jacketed approach of saying I will only look at quality or I will only look at value. I think it's the combination of the two, which is what at least I will focus on. The idea remains finding more medium to long-term growth, not get obsessed with a quarter or 2 quarters of growth. Understand industry cycles, business cycles, get an assessment of growth drivers, and see whether we are then able to find, a valuation, companies with reasonable valuation. Now, valuation again doesn't necessarily mean something that is trading at sub 1-time price to book or 10 times P or lower. Again, this, if we talk about a longer term earnings growth, then really it's futile to be looking only at the next 1 year's price earning or price to book, right? If we are talking about medium to long term earnings growth, then there has to be a way to capture that in our valuation models. And that's the reason why we go back to forecasting long-term cash flows, try and apply discounted cash flow methodologies so that we can capture some of these more medium to long-term trends and not necessarily look for companies which are cheap on a price to book or a 1-year price to earnings basis.
Sure. One question just wanted to ask on the Focus 30 fund. How do you manage risks? Because this is a concentrated portfolio. We all are aware of the risks that could be there because of the concentration in this space. So how do you go about diversifying from a sectoral perspective, and also from a, say, market cap perspective? So do you have those considerations as well, or it's purely bottom up?
No, it is actually focused portfolio is also fairly diversified, and you will see that in our sector exposures as well. The only thing is that the execution of that of the strategy is a lot more sharper. So if there is a particular theme that we want to play, then we clearly need to identify the best way to play that, and we cannot spread our bets too wide because we have that limitation of 30 stocks. As long as we are sharp in terms of our stock selection, I think even a Focus 30 portfolio can be managed with reasonable levels of volatility. I think the key in the Focus 30 is genuinely to be a lot more disciplined about many of the things that I talked about: stock selection, identifying themes, valuation approach, etc. And really, if we are able to stick to that discipline, I don't see a reason why this portfolio will be it can be just like any other flexi cap or multi cap portfolio, just with more sharper and defined exposures. The larger cap tilt at this point in time is a little bit higher in the focused portfolio, but there is no such constraint. And if we see more opportunities in the mid and small cap space, we can increase exposure in that part of the market. The only thing is that focus and that discipline of stock selection is something that we need to stay completely on top of.
Thank you. So a couple of viewers have highlighted the change in fund manager of this portfolio, because so the last fund manager also came about 1.5 years back. So just wanted to understand from you, when you take over these portfolios, is how much of changes were required to be made, or have you made changes in these portfolios in the last 1 month or so? And also, has been extremely great for this fund. I think it is a category topper also in terms of its recent performance in 1 year and other timeframes. So did it require a lot of changes to be made, or it's more or less aligned to your style of managing?
We made some changes. We must remember that since I took over the portfolio, in general, the market also has been a little bit volatile, giving us opportunities to make some changes as well. So we've definitely taken advantage of the opportunities that we have got to make some more changes in the portfolio. Broadly, however, the sort of the broad philosophy in terms of focusing on sectors where we see earnings growth over the medium term along with valuations, I think that has broadly sort of stayed the same, but we've used the market opportunities over the last 1.5 to 2 months in order to maybe sharpen the focus on some of those sectors and stocks.
Thank you, ma'am. I would like to read out one of the questions from our viewer. Mr. Rohit Sharma has asked that what could be the 3 big reasons that many fund managers are believing that private Capex will start from here on, and your views about the government Capex shaping in the medium term?
Sure. So the private Capex, there are several reasons actually. And while fund managers may not get the exact timing right, but the ingredients are all in place. First and foremost is deleveraging of balance sheets of the corporate sector. Now, unless that happened and there was ability to borrow, it was going to be difficult for companies to commit to Capex. And we have seen that deleveraging happen. A benign commodity cycle, especially in the last 12 months, has been extremely helpful. Steel, for example, has had a bonanza of a year, and has helped them to sort of strengthen clear up debt, strengthen balance sheets. So one is capacity has been created in the balance sheets of companies to embark on capacity in the next cycle for creating new capacity. Second is the bank's ability to lend. So while corporates may have cleared their balance sheets, banks also had this sort of large NPAs that needed to be provided for. So the last few years, they have also spent time in strengthening their balance sheet, providing for NPAs, etc. So, both at the borrower side as well as the lender side, we have seen building up of capacity in the balance sheet to borrow and lend respectively. The second is that some of the government schemes are a big catalyst for private Capex. The PLI scheme, for example, which is targeted towards certain industries, that is an extremely attractive sort of proposition for several industries, and we will see that spur Capex. I think estimates are somewhere between 4 to 5 lakh crore of private Capex over the next 5 years, 5 to 7 years. Lastly, I think this China Plus One strategy is clearly helping a lot of sectors because COVID has sort of highlighted the importance of having diversified supply chains. And India, by virtue of having a large domestic market, becomes an attractive place for global corporates to set up alternate supply chains. And we are seeing that in several sectors. So as we see more global corporates shift supply chains to India, that will lead to more private Capex in order to create those capacities. So I think these are some of the ingredients for private Capex to pick up. See, the other important thing when we talk about private Capex, we seem to somehow only talk about private corporate Capex. Household Capex is another important part of private Capex. And if we start to see a good real estate cycle, then the households will also start contributing to private Capex. You will see new residential complexes come up. That entire chain then starts to work, construction companies, so on and so forth. So that's why I think there are enough levers in place for both private corporate Capex as well as household Capex to pick up going forward.
Yeah, ma'am. Thank you for that. I'll just read out one question from Mr. Karthik. Uh, would you consider investing in new age companies which have gone down considerably? And where do you see good earnings visibility for the next 3 to 5 years? I think there
So
are two
where we see
parts
good
of the.
earnings visibility,
I think
where
there
we
are
see
two.
good earnings visibility. Go ahead, Ram.
Sorry. No, I think there are two different questions that he has highlighted. One on the new age companies, and the other part is on the general earnings outlook of the, say, Nifty basket or the overall listed space.
So yeah, so where we see good earnings visibility along with good valuations is where we are overweight in the portfolio. So if you look at the portfolio and you see, the sectors that we are overweight on, at least our conviction is that these are the sectors where we see a combination of earnings growth at reasonable valuations. Now, really, we don't, at least I don't think of companies as new age, old age, growth, value, blah, blah. I think clearly, like I said, the philosophy is to get growth and get it at reasonable valuations. If it meets our criteria, we are more than happy to invest in them, notwithstanding the label that is ascribed to those companies. That really does not matter. It's about making money from those investments. And wherever we see sustainable medium-term growth with valuations, we think that justify that, you will find it in the, or at least our endeavor is to add it to the portfolio.
Sure. I saw one question on Indian banks' exposure to Russia. I'm not able to scroll through and find it. I did read it in between. So one of the viewer has asked that is there a risk for Indian banking system? Are there any direct or indirect exposure wherein this whole situation of Russia-Ukraine thing can pose some kind of risk to the Indian banking system? So you have any opinion on that?
There is no material risk to the Indian banking portfolio via the exposure to the Russian corporates.
Sure. There is one question a viewer has asked on the PSU exposure. We have funds which are the other funds which are slightly overweight on the PSU basket. So, what is your view on the overall PSU segment, or do you see more value? I mean, how do you see the whole space in terms of the Indian listed PSUs?
Again, I think good companies can exist both in the public sector as well as the private sector. And, as long as these companies meet our criteria of growth at reasonable price, we are happy to hold them in the portfolio. There are some extremely good quality public sector companies as well, which are leaders in their space. Extremely good disclosures, extremely high on ESG sensitivity. If you probably, in terms of operating performance, we are happy to own these companies because they are operationally very well run. And of course, also available at attractive valuation. The other thing, of course, is that we have seen a lot of thrust by the government in order to improve the export potential slash bring in more import substitution. And some of the government companies are very well placed to take advantage of that trend. So again, I think it's more bottom-up focused. It's looking for drivers in individual companies, and whether they are public, whether they are private. If there are drivers for growth, we are happy to own them in the portfolio.
Thank you, ma'am. One question on the macro part. You did mention on the risks of the quantitative easing being the unwinding of the quantitative easing, but with the overall situation with Russia-Ukraine thing posing an inflationary risk. Will policy responses be very effective? Because this is not something that is coming from demand-led inflation. This is more of a supply side kind of an inflation. So will simply hiking interest rates or removing quantitative easing, will that be a sufficient enough weapon to handle the threat of inflation this time around?
Yeah. So that was what most central banks were talking about last year, which is that most of the inflation is supply chain disruption led because of COVID, etc., and therefore it is transitory. However, what has happened subsequently is that a lot of the inflation has actually gotten embedded. In fact, in developed markets, it has started to spill over into wage inflation. And once inflation gets embedded into wages, then it becomes sticky. And then you can no longer talk about it as transitory. And really, that's the challenge for the developed world, that they are having to unwind. Um, and they are having to unwind some of the monetary and fiscal measures that they took in an environment where inflation is actually becoming more and more embedded. See, the way for many of the corporates to, even if we think about some of the commodity led inflation, the way for some of the corporates to sort of deal with it will be to pass it on to consumers at some level, which actually only accelerates the inflationary pressures. And in an environment where you have already sort of created huge underlying pressures on inflation by very, very loose fiscal and monetary policy, there is no other way to deal with inflation than to unwind some of these measures. And that really is the challenge for central banks, because nobody wants a situation of stagflation, because that can be extremely bad for the economy. And which is why I said that emerging markets, especially India, look a lot more attractive, at least as far as the interest rate situation and inflation is concerned, because in the first place, we never had such we never had such large monetary or fiscal measures in place to deal with COVID. Real interest rates in the emerging part of the economies are much, much more attractive than they are in the developed world. Inflation is not such a big issue. So really, that's the attractiveness, I think, of the emerging markets, India in specific as well, versus the developed world at this point, where it is going to be a challenge for them to unwind some of those measures and ensure that they don't sort of impact growth as well.
Thank you, ma'am. Just want to highlight quite a few people have written questions like, when will the war end? Is the bottom of the market near? How much return we will get in 3 years? Is it a good time to invest? Are the markets expensive? I mean, this shows clearly that in the minds of a lot of investors, the first question that comes is that, even very recently, we had this thing that the markets have become very expensive. It touched 60,000 on the Sensex, and it's back to now 53, 54,000 on the Sensex. So I'm not going to ask you the same question, is the bottom now, but you also mentioned that the geopolitical events throw up opportunities in terms of good entry points. So what is your advice for Indian individual investors who are approaching the markets like this in terms of how to invest, and should they start lump sum investing at this point in time? Should they stagger it? What is your overall advice from a behavioral perspective also, not to make any mistakes, how to approach asset allocation? How do you put it all together?
No, I'm just going to draw reference to the COVID correction that we had in mid of 2020. We were asking the same questions. When will COVID end? When will COVID end? COVID probably hasn't yet ended, but we've made enough and more money in the markets. I think that's really, so we can keep wondering about when the Ukrainian crisis will end, and when the war will end, and when the geopolitical issues will resolve. But if it gives us a good, attractive entry point, we should not worry about timing. It's very difficult to predict timing. What is in our control is to see whether prices are attractive, and whether on a 3-year perspective we will, we'll make our cost of capital plus. and invest accordingly. To my mind, a lot of the themes that I talked about, see, markets have corrected across the spectrum. It hasn't been restricted to any particular sector. We have seen correction across the spectrum, and stocks that we liked even before this correction, you're getting a good opportunity to add them at lower prices. So that's the way I would think about it. I think we can never predict the end of any geopolitical issue or any event, or any particular event, COVID example that I gave. But what we can definitely control is look for attractive opportunities. And to my mind, yes, there we are seeing attractive levels in several parts of the market, which I think is definitely something that we should sort of take advantage of. The best way to do it is to stagger investments, because behaviorally also it sort of helps take that decision. So staggered investments, and also because it's tough to sort of predict timings as to when it bottoms, etc. So I think always best to stagger investments and use opportunities such as this to start coming into the markets.
One more point which we can think of is that COVID crisis was directly impacting us. As a global also, it was a pandemic, so globally it was affecting, but it has a direct impact on life and business of every Indian, the way it was coming out. This time, the correction is more because of the reason external to India. Of course, oil crisis or oil rising price is a bit of a challenge, but as Roshi rightly pointed out, it turns out to be transitory in nature. And of course, the war has to end some point in time, and the supply starts improving, and the oil starts correcting itself or starts going lowering down. Then the story of India remains unimpacted to that extent. But yes, COVID was where we had to have a lockdown for one full quarter, and something like that is not even talked about right now. So the life is going on as usual. There are some cost pressures because of this oil hike, but that appears to be transitory because the war cannot continue like this forever. So there will be some solution to that. But COVID crisis and this crisis, therefore, this fall is definitely an opportunity to add to India's story.
Thanks, Ashok. I think as we fondly remember the time when the markets corrected during the COVID times, we used to think how many years it will take to go back to the earlier highs of 40,000 on the Sensex. I mean, market surprised us all, and now we are here. And now again, we are seeing one more round of correction. So markets will keep surprising us. I think I will end the questions part here, because from a topic or a subject point of view, I have covered mostly almost all the topics that have been raised by the viewers. But some of the questions I am not able to take. So over to you, Ashok. You can say a few words, and then we can conclude the session.
Oh. Ram, I think we've covered comprehensively all the topic. Roshi started with the global outlook directly impacting us, Ukraine crisis, oil, inflation, interest rate movements. But she also very comprehensively covered the Indian part of it. That how does she look at the portfolio construction? Where does she look at the opportunity, and how she's going to go about doing the portfolio management going forward? And I'm sure, given her track record or more than 2 decades of experience in the financial market, whether with Goldman Sachs or with Templeton, I'm sure she'll be adding a lot of value to these 2 portfolios that has been interested to her. And Roshi, we look forward to many more such engaging opportunities with you. Good luck to you, and welcome to HDFC family. And Ram, we can conclude the call.
Thank you.
I just want to take this opportunity again to thank everybody on the call. It's been a sort of a tough day today, and yet you took the time to come on this webinar. Thank you very much.
Thank you, ma'am. Thanks a lot. Yeah, we'll end the session. Thanks.
Bye, Ram.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.